Moving swiftly on, we have our first panel discussion of today. I'd like to welcome William Powell, Editor-in-Chief of Natural Gas World, who will then introduce his panelists, and which will be a bit of an investment outlook for 2018. Welcome.
Good morning. Good morning, ladies and gentlemen, and thank you for coming, and many thanks to the organisers for inviting me out from London to come here. We have a very distinguished panel of speakers able to comment both from the industry side and from the financing side on the state of the market today. And I'm going to begin with a very brief overview, which is to say that it's been a very good first quarter for most of the majors. They've all seen very high oil prices year on year. It's now knocking around the $75 a barrel mark on the peak days. That includes, of course, some risk built in for threat of sanctions on Iran, but also demand is certainly growing, and now the question more is about how the supply come in. So on my immediate right, we have Ian Lawson from BP, followed by Josh Bartlow from Clearwater, followed by Stefan White from LIM, and I'm going to begin by inviting them to comment on the questions which are on the program about how you see, first of all, the OPEC and the market moving forward, and what this means for investors.
Whenever I'm asked what I think about the flat price of oil, it's always a hard one to call because we don't really trade it. I work for the trading arm of BP, and oil, in terms of flat price, is just too macro. It's driven by Twitter, like whatever Trump's saying on Twitter. It's driven by Syria. It's driven by China. We don't have any natural advantage over the rest of the market in deciding whether the price is going up or down. Most of what we trade are dislocations. We trade dislocations in quality, dislocations in time, dislocations in geography. And we believe that we have some kind of advantage from our analytics and our physical position on the back of that. That said, it has been an extremely healthy environment for oil. As we saw from Christoph's speech, demand over 2017 has been resurgent. The growth from Asia, China and India in particular, is certainly there. And I'm very pleased as well to see Christoph focusing on the impact of IMO 2020. I think that's going to be huge, and I think there will be very, very clear winners and losers, both on the exploration and production side and on the refining side. Things will sort themselves out in the long term, but in the short term, it will be a huge perturbation. It would be a big shock to the market, and we don't think that the market is ready for it. So there will be opportunities around that, and producers with the right grades of oil could find themselves having a very pleasant windfall. We talk about the oil companies and how they've been doing well over the last year or so. It's hard to say what exactly an oil company is now. If you look at some of the Seven Sisters, increasingly they are becoming gas companies and trading companies. It's certainly how BP would see themselves, and Shell is now certainly far more of a gas company than they were. There were rumors even that Exxon was looking at setting up a trading operation over the last year or so, so that would definitely be a sea change. But the crude price is great. We're very happy to see things around the 75 level. Almost more significant is how the supply curve has been pushed, or the cost curve has been pushed to the left. Many people now have a break-even sub $30, so the upside benefit of oil at $75 is much greater than it has been in the past. There's much more bang for your buck as you move away from your cost of production, so extremely happy to see levels at these points. OPEC compliance has been fantastic. It's been more than 200% for some countries, probably involuntarily. So we think this is an extremely healthy environment. In general, if you're part of a trading organization, you like uncertainty. And with IMO 2020, with the geopolitical situation, that uncertainty will stay. So we have plenty of reasons to be bullish crude oil and potentially bullish gas further down the line.
Josh, how do you see the market now for investors in the oil and gas sector, particularly in Asia?
So I think the way, so Clearwater, we provide alternative capital to the space, primarily in debt. So as we look at the market again, as my colleague just said here, we like the $75 oil price. It is very interesting. It's definitely helping our investments we've made in this sector over the past several years, but we're not underwriting new deals today at $75 a barrel. We typically like to, oil has a large impact on the investments we make in this space, so we follow it closely. We typically like to take a range. So following the 2014 downturn, we've kind of taken a view that we would invest in companies that would survive, that would be okay in a $40 to $60 range. Given oil now is trading closer to 75, those companies are doing very well. The new deals we're looking at now, some of them have a $60 base case in them. But we have not brought anything to committee. We've not actually made any investments, pulled the trigger on new deals where we've actually stepped that up. We want to see oil price hang in here a bit longer. We want to see more clarity around what's going to happen. OPEC's done a great job with their strategy, reducing the inventory in the system, taking the market into a backwardation now, where you see a higher spot price. But still, I think we don't see this as a straight line. We think the market's going to continue to be volatile. And frankly, not an expert in trying to call the oil price. So we still look at making investments in a range. I'd say it's probably more of a 50 to 60 type of a range now. So we want companies to be able to survive and to do okay on a base case in that type of an oil price range. Of course, we're very happy when oil price trades above that because, we see companies doing better than our expectations. But we have not made a decision to kind of increase our threshold level.
And Stefan, how do you see the market?
Thanks. I work at Lim Advisors. We're also an alternative investment provider, principally credit, but to some degree also equity. I personally have a constructive view as to where pricing will go. I don't think it's going to be hyperbolic going up, but I think it could stay in this range. I think OPEC. My view with OPEC is quite simplistic, but I think Saudi was basically losing market share to China. I believe at one point about 10 years ago, about 20% of Saudi's production was going to China. That seems to have halved, and I think it seems like perhaps there was a Saudi strategy thinking that if they adjusted price, they could ratchet up some of their the share of their oil going to China. I think that but lowering the price didn't seem to make any difference in terms of how much China bought from Saudi, and I think Saudi's obviously got their own reasons for needing actually quite a high oil price, given all the social subsidies that they have to support. So I think that certainly from a Saudi perspective, I don't see there being a particularly any incentive to really lower the price. China's share has sort of stayed of Saudi oil has stayed quite constant at around 10%, and it seems that between Russia and Saudi, they've found a way to basically control the situation and also control their neighbors. But one never knows. I'm not. We're not making investments on the basis of $70, $80 oil. We're similar. Our price decks are looking at typically 50, 55, dollar scenarios to see how things stack up.
And this question mainly to the private equity colleagues on the panel. What sort of life cycle are your companies typically looking at? Is it full cycle, or do they go in at the early stage and then quit when they've brought a project to development? Or how do your clients look at the oil price? How important is it in their decision making, in the short term or medium term?
Well, for us, we typically we're biased towards production, and if it's pre-production, we'd like to be very close, sort of last mile, before the production.
We're the same. So last mile development, financing, production. We'd like to see companies that have a diversified base of assets as well. So we'd like to see something in production. Perhaps we're funding the next development asset. In this stage of the cycle, from a credit perspective, we would not be providing any capital into exploration or early part of the cycle.
And looking on the risk side, particularly from the governmental side, Asia, of course, contains a very wide range of jurisdictions. How would you advise your clients on where to look for? Do we the stable regimes, OECD countries, or are there richer pickings to be had in smaller provinces where there's more instability but possibly higher reward, such as Southeast Asia?
Well, I think as an example, in Indonesia, you can come across opportunities that will give you a high teen to sort of a 25% type return. And the reason there's that type of return is there's actually quite a bit of captive money in Singapore to be investing towards that region. And my personal view is I don't want to be competing with that captive money that's actually dedicated to that region. I can find similar returns in better jurisdictions, whether it's North America or Australia. So I think it's certainly for us, we'd be biased towards good jurisdictions where we know we can enforce, and where we know corporate governance are better in terms of working with boards if the company is publicly listed.
I'd say we have a similar view, and again, we prefer diversification. So we would take some of these less desirable jurisdictions in a portfolio approach, but wouldn't want to have all our eggs in one basket.
Just to chip in here as well, I mean, BP and some of the other oil companies, particularly the trading companies, have got increasingly involved in the investment space over the last few years as a source of alternative finance. And I'd probably echo some of the things that my colleagues have been saying. We would find ourselves potentially making investments that are driven by access to physical barrels, where we think there's some kind of trading story to be made, but we probably wouldn't get involved in anything that's more than about 18 months before first production, and even that might be a stretch. Jurisdictions, we can be quite flexible, but again, it's going to tend to be driven by the story around the trading of physical barrels and access to those, rather than anything else.
I have a particular bias being a gas journalist. I'm wondering whether you see any particular tendency towards investment in gas projects or towards oil projects. I know oil offers better returns, but gas is becoming increasingly marketable now, particularly with more flexible LNG. I'm wondering whether you see your clients asking about or interested in gas, and also whether BP itself is, apart from the Tangguh development.
Well, I mean, gas is increasingly a big part of our business. I mean, we just committed to Train 3 of Tangguh. I think we're the biggest gas producer in Indonesia. And we do see ourselves in transition from an oil company to an energy company, and gas is a very large part of that. I think one of the most exciting things about gas over the past few years is how quickly it's made the transition from being a virtual pipeline market where the premium, or if you like, the economic rent, accrues to the producer in return for security of supply. In the past, the Japanese, the Koreans, to an extent the Chinese, were willing to pay a premium for gas dedicated on a particular vessel coming up from Northwest Shelf or Tangguh or anywhere else, just to ensure the security of supply. Now you're seeing much more of that economic rent accruing to optimizers and traders. There's much more value in the midstream, there's much more value in being able to optimize around a portfolio. So a lot of the investment money into gas might find itself looking at the assets that support that ability to trade in gas rather than simply the production of the gas.
Do you have any views on the desirability of gas over oil?
I mean, my personal view is quite constructive. I'm very excited about what's happening in gas markets and technologies, and I think what's interesting about gas also is it's still very much a regional play in most circumstances. So you've got region-specific dynamics, which I think are very interesting, like what's happening in Australia in the east, to some extent in a delayed fashion, also happening in Australia in the west. You've got very strong demand from China happening for a number of different reasons. So I think that the gas narrative is one that's actually very interesting, and where we'll see a lot of growth in demand, and at some point, at the moment I think we're oversupplied, but I think that that could become a very interesting story in the sort of around the early to mid 2020s, in my view.
I think it's the oversupply story is very interesting because we've been talking about a glut of LNG till the mid to early 2020s, but in fact all the cargoes that are produced seem to be getting a very good price, around sort of $8-12 depending where you look in the world. So I think probably there's been a lot of overhyping this gas bubble because the demand is certainly there, particularly last Q4 when China imported more gas than ever before through LNG, and it's also found new ways of delivering to the customers with trucking and so on. Before that was impossible. Now you have trucks, I think almost a quarter of the LNG at some terminals was being taken to the customer on the back of a lorry rather than through a pipeline. And this just shows to me how gas is becoming more and more like oil in many respects. There's certain key restrictions in that you can't, it's not a storage play like oil is yet, but with ISO trucking and now I think cutting boil off dramatically, so you can now store for like over 100 days. That's a huge development, which must be good for companies which are moving into gas, governments which have certain environmental restrictions in place, and of course shipping as well, because bunkering is going to be a bigger part of the picture, and financing again will presumably be affected too with bunkering, new regulations, types of projects which can find financing. Do you want to talk about that, Ian? Or?
Yeah, I mean, just to say a word, one of the questions on the sheet was what's the role of governments in helping the people in this room make investment decisions? And one of the biggest roles of government, I think, over the next 5 to 10 years will be in dictating the pace of the transition. There's no question that we are transitioning to a potentially more electric future. As Christoph mentioned, I think even with the most pessimistic scenarios for oil, we still don't see peak demand for oil anytime before about 2040. So oil companies, whether they're called energy companies or oil companies, will be here for some time. But governments certainly have a role in dictating the pace of that transition. And it's a very hard thing to call. Ultimately, what's being driven by the pace of that transition is the pivot from transportation fuels like diesel and gasoline to generation fuels, ultimately LNG, but in the short term still fuel oil, and coal to some extent. I mean, coal is very much seen as a sunset industry, certainly compared to gas, but coal will still be, by our calculations, a very large part of the generation market over the next 20 years. So the role of the government is very much going to be in setting the pace of that transition, but we think even the most pessimistic transitions still call for growth in oil investment. I mean, one interesting statistic is if oil investment stops today, by 2040, I think global production falls to around 45 KBD. So anyone who has investment to make in oil, we're going to have a need for you all the way out to 2040.
Going back into the question of the oil price, there's been a lot of narrative again in the media that the ability of the US shale to cap prices at a certain amount is unquestionable, and therefore there's no reason to pay more than $70 ever because that'll draw on more supply from the US. What are the flaws and fallacies in that argument? Do you think, Stefan, first?
Well, I think one of the principal flaw I think is that the U.S. is becoming quite infrastructure constrained. Mm-hmm. So I think the ability to just pump more into the system is potentially starting to reach some limits just in terms of pipeline limitations. So that's certainly a short to medium term and perhaps longer constraint, because just putting in a new pipeline or new capacity is not that straightforward.
Josh, do you agree with that, or do you have any interest in that part of the world? Perhaps you don't.
Yeah, I think people focus a lot on shale, and I think that part of this supply demand, as you start modeling this out, is if you look at the actual capex that oil companies have cut in the past 3 years, aside from shale, but offshore drilling's down 60% this year versus the peak in 2014. This is money that are on projects that are 7 to 10 year life cycle projects. So not only are we seeing caps potentially in shale, but I think that there's going to be a continued impact of this capex cuts over the past 2 to 3 years that's going to impact the production. Maybe less so last year, less so this year, but as you look at 2020, 21, 22, the lack of capex over the past few years does have an impact on the future supply. And if you're seeing supply constraints coming from shale, can set this market up for a pretty strong market, say, if you look 3 to 5 years out.
Yeah, I mean, I think you can see that the constraints are there in shale by looking at the volume that's currently being transferred by rail. The pipelines are full in many cases. And I think what we'll find is that as long as those constraints exist in the US, an increase in shale doesn't necessarily have a major impact in global world crude prices. And we've seen this before. There have been massive dislocations in Brent to TI simply because of export constraints in the US. And even if shale production in the US ramps up, as long as those constraints are there, you may see the WTI to Brent or other grade differentials acting as a buffer to the global market, letting, say, Brent as a better marker for global crude rally more or less freely, while the WTI or other US grades are relatively more constrained.
And looking at Australasia, which I believe is your particular company's interest, Stefan, do you think the lifting of the Northern Territory's moratorium on fracking, do you think that could have an impact, or is that going to attract companies to think more into gas? Or
I think it could have an impact, but it's kind of way beyond the time horizon of the stuff I'd be looking at, because I think by the time we see that impact, it's several years out at least.
And where do you see the interest now in Australia and New Zealand?
Well, I think for alternative lenders like ourselves, there's still some opportunities. It tends to be smaller, junior small cap companies. There's opportunities in the gas space, some offshore oil opportunities. I think in general, the challenge is that the bank funding is difficult to get for these companies, so the cost of the funding tends to be pretty expensive.
And Josh, do you see many changes in the way financing is coming about these days? Are people leaving and new people taking their place as providers of equity or of debt?
Yes, I think we are seeing changes there, and one of the challenges that we have today in putting new money into the sector is that there's a lot of companies out there that have balance sheets from prior to the 2014 downturn. So there's a lot of over-leveraged companies, and in the bank debt, European bank debt example, you are seeing banks that are exiting the sector, that are now going green and trying not to invest into the oil and gas space. So you have kind of market participants that are leaving. I think there's not really a lot of people that filled their shoes. So what we call the secondary market, which is actually buying existing loans at a discount to par, has been quite robust over the past few years. And when we look at a new investment of lending new money to a company, it has to compete with buying something secondary in the market. And you're still seeing secondary debt in the upstream companies trading with yields 13, 15, some up to 20. So that's really when you price out a new deal that's coming to market, they're coming to market trying to borrow money at 9%. I can buy something in the secondary market at 80 cents on the dollar that's yielding 15%. It's not competitive. So that's one of the challenges that we're seeing. And really over the past 2 years, I'd say in Asia, kind of the small, medium-sized companies, there's been very few private lending or kind of small club credit deals that have been done because the secondary market has been so attractive.
And I think to add to that also a little bit is that there's a refi risk, and we see this particularly, for example, in coal. Coal is quite straightforward. A lot of banks just don't participate in that space anymore. So we may find a really compelling coal deal, even providing us the type of return that we want. But the question is, who's going to take us out? And so when we're looking at potential opportunities in oil and gas, we also need to price it in such a way that we feel confident there's going to be a compelling takeout scenario for somebody down the line.
And Ian, how is BP adapting to the new financing world?
There's been a lot of trading company money coming into the space. Again, very often driven by trading opportunities around the physical. The oil companies in general haven't been as nimble as companies like, say, Trafigura, Glencore, Vitol, Mercuria, simply because their balance sheet structure is very different. It isn't hard for, say, a Trafi to raise money through trade finance structures and to then use that money to go out to small to medium-sized companies and do things like prepays or structured lending tied to the price of oil. That's not something that traditionally the oil companies have been very involved in, but we're finding ourselves more and more involved in that. Again, if there is a compelling story around physical gas or physical oil, we will look at using our own balance sheet or working with more traditional lenders to put together a deal that de-risks the physical offtake, potentially overlays hedging. It's a very good environment for that at the moment, in a way that puts together a structure that works in an otherwise very difficult to bank environment.
Are there any questions from the floor at this point? Because we're running towards the end now of the allotted time. So if anyone from the floor wants to ask a question, please feel free to raise your hand.
Thank you, Brian Anderson. The question about shale oil outside the United States. I mentioned China. Does anybody have a view on that? I know it's slow and difficult, and it's not like the US, but do you think that would change things?
I think the US is a fairly unique situation. I mean, shale oil arrived with the infrastructure already in place. I think shale in China has a lot of potential, but it's regional rather than even national, and certainly regional rather than global. The US worked for a very specific set of circumstances.
Can I ask the panel what they think now about the stability of the oil price, relatively speaking, to how it was in the last 4 years or 3 years? There's a lot of distance between the buyers and sellers until recently, because now we've seen oil price relatively stable around $60, and there was may have been coincidental or not, but there's a wave of M&A activity, particularly this year in the UK, the North Sea, OECD regime stable, fiscal regime. A lot of people thought, okay, this is going to be now a price we can do business at, and people are structuring their deals now with contingency payments, so if the price goes up or if production targets are hit, then there's more flexibility on how much to pay and when. So do you think now we're on the threshold of a new era of M&A?
I think the reasons that people invest in oil and gas companies are changing. In the past, it was very much around the blue sky. You buy because you think the price of oil or the price of gas is going up. Now it's much more about the ability to efficiently manage a company, the ability to optimize the assets, the ability to de-risk if it's necessary through hedging or offtake. People aren't necessarily buying into it as a straightforward punt on the oil price.
In the companies we're involved in, we're seeing more interest, I would say, rather in straight up M&A of the corporates is actually selling assets. So we're definitely seeing companies that have over-leveraged balance sheets, selling off assets, repaying debt, and there's definitely a bid in the North Sea, as you say, for assets, producing assets there. And I think that the bid-ask spread has definitely narrowed, where they are able to sell assets, repay debt, and try to right-size balance sheets. But in a lot of these kind of small to medium-sized companies, I think that there is not necessarily the obvious buyer for the corporates today.
Yeah, I think that what we're seeing is for larger assets, there is actually strategic interest, and strategic interest willing to pay actually pretty reasonable premiums for what is deemed large strategic long-term assets. But I think from a financing perspective, there's still a lot of debate and uncertainty as to where prices could go. The price downturn we saw just 2 years ago is still fresh in many people's mind, and just how quickly prices can move, down as well as up. So I think from a financing perspective, I think there's actually still quite a bit of debate, especially from institutional sort of bank type lenders. And across the board, I think even for alternative lenders, I think hedging is very important, and there's a cost to that. So that needs to play into the economics of the return you're going to get.
I was thinking maybe with this record level of indebtedness in the US, there'd be a lot of companies out there who'd be begging to be bought, but you didn't see that happening, perhaps, or maybe it's just a slow process.
I think there's definitely been some companies basically optimizing their balance sheet, but because of the high levels of debt. But on the other hand, the animal spirits are still very much alive in terms of providing debt. So there's still a number of companies that are succeeding in attracting more debt and are actually quite levered in North America.
Any more questions from the floor? Because I think if not, we've reached the end of our allotted time. So with that, I'd like to very much thank our panelists for giving their thoughts so freely. Thank you very much.
Thank you, gentlemen.